The world, by design, has been overweight US assets for a generation, and we now have an administration which has taken at face value, is sending a very direct message over and over again to global capital. And I paraphrase, please go away.
Marko, Louis-Vincent, James, I'm so appreciative you're able to hop on. I think to start, and so people listening on audio can calibrate your voices, why don't we do a quick round, almost if they're only listening for a few minutes. So why don't you go ahead, give your name, where you are in this moment geographically, and also what's the most important takeaway that you have in this kind of interesting time? James, why don't we start with you?
Well, Ted, thank you for convening this. And can I say at the top, this is the thinking investors equivalent of CNBC's Markets in Crisis. We've only got 4 heads on the screen. Ideally, we'd have 12, but here we are. Look, James Aitken, Wimbledon, United Kingdom, Australian. And what we're dealing with now is the consequences of Mr. Trump. But the executive summary is the world, by design, has been overweight US assets for a generation, and we now have an administration which has taken at face value, is sending a very direct message over and over again to global capital. And I paraphrase, please go away. Please go away is the message, and that's what we're all dealing with right now.
Louis-Vincent?
So Ted, thanks a bunch for having me. It's great to catch up with James and Marko. My name is Louis Gave. I'm dialing in from Istanbul. I'm here for a friend's wedding, just here for the weekend. Heading back to Hong Kong pretty soon. My theme isn't very different from James, to be honest. I think we're living through the end of the era of U.S. exceptionalism after a 15-year outstanding run. The U.S. dollar is now rolled over, and I think most people's portfolio is on position for a world of weaker dollar and one where growth is outside of the U.S. is going to outperform growth in the U.S.
Marko?
Hi, I'm Marko Papic, and I am dialing in from West Coast, from Santa Monica. And I am from a country that no longer exists, so a nihilist, if you will. And what I would say is that I think you did a poor job of assembling this panel, Ted. I have absolutely nothing to add to what these two legends have said. I don't even know why I'm here. I mean, I guess you need a pretty face, because I'm just going to say one word answer. Exodus. Movement of the people.
Well, Marko, why don't we turn to how you get to that conclusion?
Let me try to say something different. I would argue that if Vice President Harris had won the election, we would be in the same boat in terms of the peak in U.S. assets. We just wouldn't have as extraordinary of a sell-off. So what would have happened under Trump in 12 months would have probably happened in 4 years. I think that the U.S. exceptionalism was truly exceptional from 2010 to 2020. We can articulate the exceptionalism of U.S. markets during that period of time, which was low growth, low inflation. You want to be in long duration assets, of which tech is probably the premier. But from 2020 onwards, I think we've all been fooled. I think productivity data is a joke. It's just output per hour worked. And if I dumped a wheelbarrow of cash on your heads, you would look pretty productive as well. We've been riding a fiscal orgy where the US basically outspent the rest of the world by an extraordinary amount. The underlying reasons for this have nothing to do with the pandemic or the virus. I mean, we all lived through it. In America here, we didn't really particularly care about the pandemic. So then why did we spend 4x what Europe did in fiscal policy? It's populism, it's income inequality, other things. And so if you look at the performance of the markets, and again, Louis and James are better than me at this. I mean, they can confirm this. Like, the dollar didn't peak on Liberation Day. The dollar didn't start selling off on Liberation Day. It did in January. And really, it did when the bond market disciplined American legislators. The constraint on American legislators is the bond market, which rioted when the human steepener was elected as president. And we saw, 100 basis point cut in the Fed funds rate. and a 100 basis point move in the yields higher, which hadn't happened since the 80s. And so I think there was a bond market riot that spooked members of the House of Representatives to start curbing. There's a revolt effectively going on in Congress. And again, I apologize to talk about something extremely unsexy because we want to all talk about trade. But I think that this move in US assets peaking really started when the bond market disciplined American policymakers. And then we all as investors had to reprice American growth differential relative to the rest of the world. You see, when President Trump started being bid up as a candidate, there was assumption that Trump 1.0 would be replayed. You're going to have populist generating high nominal GDP growth, demand promised 10 to 15 trillion additional deficit spending. And all of that started being cut in January, February of this year. And then, of course, you have the trade. And I'm going to just concede to James and Louis on that front. We can go into that. I just wanted to start off with something unsexy that's not really talked about. It's the fiscal gravy train that gave us exceptionalism of the U.S. asset flows from 2020 to 2025. That's over.
So, Louis, James, I want to go back to the first order effect. We'll get to second, third, maybe fourth afterwards. Any additional thoughts to the framework that Marko just proposed?
Look, we can talk all day about what's happening in the U.S. I think there's obviously a wider world. And yes, the end of U.S. exceptionalism has a lot and mostly to do with the policy choices of the U.S., but also just, a natural order of things. Trees don't grow to the sky. Valuations relative to the world were very stretched, etc. At the same time, we have to acknowledge that we're seeing very important policy shifts in both Europe and China. I spend a lot of time looking at China. I live in Hong Kong. We have an office in Beijing as well. And, the story of the past 6-7 years in China was a story first and foremost where all the capital was being allocated to industry. The banks were told, don't lend to real estate anymore. Don't lend to the consumer. We have to build industrial resilience because the U.S. is trying to constrain our growth. It's not giving us access to tech, not giving us access to semiconductors. So we're going to have to build everything ourselves. And this has now shifted massively in the past 6 to 9 months for a number of reasons. The first reason is, industrially, China is much more confident and comfortable with where it stands relative to 5-6 years ago. At this stage, it basically dominates pretty much every single industrial supply chain. So that's number one. I think number two, China's big fear over time became that the U.S. would try to build an anti-China coalition. Now, funnily enough, having declared trade war on everybody, the U.S. administration is now trying to pivot to creating that coalition, that anti-China coalition. The odds of that succeeding are probably very low, and the Chinese and I think the Chinese are starting to be much more relaxed about it. But third, with everything happening in the world, China now realizes that it actually has to promote domestic consumption. And so you're seeing a very, very important policy shift in China today, where, again, for the past 6 years, all the bank lending, everything has gone just to industry. And now all of a sudden, all you hear about is boosting consumption and boosting loans to local authorities and boosting loans to real estate. So an important policy shift in China. And of course, at the same time, an important policy shift in Europe. I think in Europe was always torn between the parts of Europe that were far more conservative fiscally and reluctant to step on the fiscal accelerator, and the parts that were always more profligate. And now there is no such splits. Germany was the very embodiment of the reluctance to expand fiscally, and that has just been thrown out the window. So essentially, it's almost, I don't know if any of you guys ever played Uno with your kids, but it's like the markets have just had the Uno reverse card dropped on us, where the U.S. was doing massive fiscal spending and China and Europe were not. And now the U.S. is doing fiscal consolidation, just as China and Europe step on the fiscal accelerator. Where it's reverse Uno card.
Yeah, Ted, I feel like I haven't done enough prep because I wish I'd coined the phrase human steepener. I wish I was clever enough to come up with the metaphor of reverse Uno card, but obviously I've got nothing. If I may paraphrase a little, what our two friends are both saying is that there may be a chance that for all the difficulties over the past several years, the Chinese leadership may have been preparing for exactly this moment. And whether it be delivered to them under an extension of the Biden-Harris regime or frankly accelerated under this president, whatever one's priors about the regime in Beijing, and I think you're well aware of mine, China has options here. I mean, it's brutal. And as Marko pointed out this morning in a social media post, I mean, look, let's face it, China is prepared to suffer. It's not obvious to me that the US consumer is in the same way, just as an observation. But what we're describing is winners and losers. We're describing an end of some description to US exceptionalism. And to be very clear, we're not saying the end of the dynamism and the entrepreneurship and everything else that has made America fantastic for so many decades. We're not saying that, right? We're not saying it's the end of Silicon Valley and innovation. Of course it's not. It's going to remain a dynamic entrepreneurial country. What we're saying is that the marginal dollar of capital flow is going to go somewhere else because it's been told, go somewhere else. And I just want to drill down on that a little bit, if it's okay, because I think people understand. Look, some of my clients say to me, oh, what's Trump's plan? And I say, plan is a very strong word. And they say, what's Trump's strategy? I say, strategy is a very strong word. How about we go with what's the ideological agenda that's behind all of this? Now, look, let's be clear. There are some good points here. Firstly, obviously, the US fiscal situation is unsustainable. We really ought to do something about it. Yes. The trade situation so far hasn't bothered us, but perhaps we should attack it because we want to do more for US manufacturing and Main Street. Okay. Oh, we think many parts of the rest of the world haven't paid their fair share to shelter under the US defense umbrella. Of course that's true. So the broad talking points are correct. But when you say over and over again, and they're not misspeaking, that there will be some kind of traffic light system, a green light for people who are in our orbit, who want to invest here and do business with us, then an orange light and red light system. And then simultaneously, and I'll defer to Marko and Louis on this, but you take a Stephen Mirren who has that infamous paper, which I think he never wished he'd written, and he's speaking on Monday in the midst of a bond market rout and saying out loud at the Hudson Institute, well, maybe people can just wire us the money to Treasury if they want to transact here. To a lot of my clients, that sounds like we're going to tax your capital flows. And taxing capital flows is a very short step away from capital controls. And for obvious reasons, we do not want to go there. So the message is clear. The broad brushstrokes of the agenda are clear. They would probably view, as of now, that this week has been a success. I kid you not. So the dollar's down. The equity market has stabilized off Monday's lows, okay, tenuously, but here we are. The bond market is still frisky and under pressure, but the sell-off has slowed a bit. So they'd probably view what they've done this week as quite an achievement, but let's be clear, it solves nothing. All we've done is buy time, and the reality is that we're going to have 2 quarters of global growth that are going to be absolutely horrible. And in that context, the market clearing price of earnings, and therefore the market clearing price of equities in general, in the US in particular, must be lower. The market clearing price of credit in general must be wider. And I think it'll emerge the problem there is not down the capital structure, it's the world's overweight in US investment grade credit. A lot of tests to come. And I think anyone who's trying to say, things are oversold, might need to take a cold shower, because I don't think we muddle through from these levels. We may well muddle through, but it's a very difficult couple of quarters ahead. And we can go into further detail, but I'll stop for a sec and just say it's all very well to have some kind of tariff moratorium for 90 days, which, did you all know, 90 days from now is the 4th of July. How about that? It's all very well to have a moratorium. It's all very well to say the average tariff for people who are nice to not us, to me, who are nice to me, the president, they'll probably get away with a 10% flat tariff. But that doesn't matter. If you're going to impose a 145% tariff for any period of time on the world's factory, nothing works. And I will pause, I promise, but an anecdote from a client last night. You're already seeing covers at restaurants and everywhere fall, travel's falling, and there are 3 flights a day from Heathrow to Boston with British Airways and many more to Kennedy, etc. And nearly every day, those flights from Heathrow to Boston, Logan, are full. That's why they have 3 of them. And a client sent me a photo last night returning from London to Boston, and she was the only passenger in BA business class. And she's like, what is happening out there? And that is a metaphor for a sudden stop. And I know sudden stop sounds dramatic, but that's what markets are wrestling with as much as everything else. This is a sudden stop. Even if this weekend, and I think it's probable, we get big, beautiful tariff trade negotiations with Japan and South Korea and maybe some others, it's too late to arrest the jolt to confidence, the jolt to capex, the jolt to business spending, the jolt that will soon start to impact consumer behaviors as well. At a time when the administration, again, I'll keep saying it, is telling global surplus capital that has underwritten the US outperformance to go home.
So I'm seeing a lot of head nodding as each of you are going through this, a lot of agreement, painting the landscape. James is nodding his head no. Well, let me give Louis Marko, Louis, go ahead. Something you heard that you don't necessarily see eye to eye with.
No, look, I completely agree with James. Look, like him, I think, of course, you'll get a deal with Japan and Korea. But to be honest, that's like taking your sister to the prom. It's, it's like if you're Japan and Korea, you're dependent on the U.S. security umbrella. You've got U.S. troops in your territory. You're always going to do whatever deal the U.S. puts in front of you. And that's the simple truth. And as James points out, what really matters is that in the past 10, 20 years, China has become the world's factory. If today, imagine you're a property developer in the US. Today, the reality is your appliances, your pipes, your tiles, everything you use to build the house, go to your Home Depot, you'll find that 70, 80% of the stuff in there is from China. So today, who in their right mind starts a new project when really you have no idea what the cost of anything that you're going to build your house with is going to be? Not only the cost, but whether you'll even have it. Sure, all of you have gone through housing projects. You know that if the pipes are a week delayed, it's a bloody disaster because then the plumber doesn't come in, and then that pushes the drywall guy back. And, these are like finely tuned machines. We saw this kind of discrepancy during COVID, and it took the economies a year to sort of get back on their footing. And this time, it's going to be just as bad. So, like James, I don't see how the economy doesn't grind to a standstill. In the United States, these trade discrepancies are going to be very unique to the U.S. They're not going to be elsewhere. But of course, you could say, well, when the U.S. catches a cold, the rest of the world catches pneumonia, et cetera, et cetera. But this is where, again, it gets interesting. This is the big unknown in this cycle. The U.S., essentially they're slamming on the brake and they don't have a seatbelt, so they're going to be slamming their heads against the windscreen. Europe and China are countering this with greater fiscal, policy and fiscal spending. So it'll be interesting to see whether they can withstand the shock that's going to be coming out of the U.S.
Can I maybe ask a question to Marko just to differentiate a bit? Because I don't want any of our listeners to think, oh my gosh, we're all going directly to hell. There's some challenges ahead, but, opportunities that we'll get to as well, obviously. But Marko, there's this popular narrative for too many of us in markets, frankly, that, our mutual friend, Ted's former business partner, Scott, he's one of us. He's a markets guy. He's going to be Treasury Secretary. They would never do anything to hurt us. Is it right to imagine that what we're actually talking about here is far bigger than the next GDP print? It's far bigger than core inflation. It's even far bigger than where the S&P closes on any given days. It's just far bigger than all of that. How should we think about it in a broader context? And is there any good historical analogs?
Yes, I think so. And one of my core theses for the past Well, since I joined finance, which is later than both of you gentlemen, all three of you actually. But
Thanks,
Well, you're
Marco.
much younger.
Appreciate that.
You're
thanks.
much younger, mate.
I don't mean that. I don't mean
No,
that.
no, it's okay. No, it's okay. We're not being sensitive. We're just being factual. That's okay. Keep going, young man.
I'm a failed political scientist, so I kind of backed into finance, and one of my core tenets has been we're in a multipolar world, and I know Louis agrees. I mean, his book is very much along those lines as well. And in a multipolar world, there are certain constraints. One of those constraints is what Louis said. It's going to be very, very difficult for the U.S. to build a coalition. So the analog is the 19th century. And this is the problem, because we're all trying to fit a square, peg into a round hole. We all keep trying to think about bipolarity, China versus US, and so on and so on. But the reality is that I don't think it's going to be China versus US. It's going to be very difficult to build a coalition against China. And so that's the analog. Now, the 19th century was not a bad time. Globalization did not collapse. Actually, enemies traded with one another. And so everyone keeps waiting for this bifurcation of US and China, and it keeps becoming very difficult to do that. And one of the simple reasons is, allies can't coordinate well in a multipolar world. It's not that they're not allies. It's not that France and the United States wouldn't go to war together against China if we had World War III. It's that until that moment comes, France has to sell Airbus to China. And if France sells Airbuses to China, then Boeing has to sell them as well. Otherwise, US will lose out significant real gains. So that's the first thing I would say. That's like the good analog. And because none of us have experienced this, our grandparents, by the way, have not experienced true multipolarity. We as investors keep falling for this fake, false model of a Cold War in a bipolar world. But where I would disagree with you, James, where I would to add some disagreement here. Obviously, what I love about you, Ted, is that you've created a platform for allocators. This is my bailiwick, I think. I don't think you want to day trade Marko Papic's views. I think all three of us are here in agreement that there's an end of U.S. exceptionalism, and that's what really matters for long-term investors. If I were to offer my modest view on day trading, I would just warn one thing. I think, James, you can be correct completely on hard data and fundamentals, but we may have seen the bottom anyways. And here's why. In policy-induced recessions, what really matters is the second derivative in policy, not data. Market's going to look through 2 quarters of terrible data. If the outcome is it starts to be revealed that this is all a lark, that this was all for lulls, and that President Trump is just cooking, as White House official tweet told us, let him cook. What? Okay. Yesterday, he says, I want to deal with China. He reiterated, by the way, he said that first cabinet meeting this year, he says, I'm going to get a deal with China. He reiterated last night. He was asked, what about their Hollywood ban? He smiled and said, well, they could have done worse. It's all a joke. It's all for the ratings. And my point is, once the market sniffs that out, they're going to be like, oh, okay, so the worst is over. And the example of this that I would compare to is COVID. Remember, lockdowns, hospitalizations, we all became obsessed with all this stuff. But the truth is, the markets bottomed on March 23rd, 2020. I think the response is not going to be that. It's going to be President Trump saying, I was actually going for 5 to 10% across the board tariffs, not 40%. And once the market snips that out, I think it's very dangerous to be overly bearish on risk assets.
I want to turn to taking those views, the end of U.S. exceptionalism, what might happen, China and Europe, and how do we think about applying them to different markets? Yeah, not, as Marco said, not what's going to happen tomorrow or Monday, Tuesday. We have no idea. But if you look at a global asset allocation today and say it's roughly market cap weighted, there's public market exposures, there's private market exposures, fixed income exposures, how would you suggest someone think about the implications of those shifts over different periods of time? And that could mean a year from now, it could mean 3 or 5 years or longer. I don't know, Louis, do you want to tackle that one?
The obvious argument we've already made: people are too overweight the U.S. and they're too overweight the U.S. dollar. So that's your first trend, and then you get to the question, indeed, of okay, that all sounds great. What do we buy? For me, there's a few things happening today uh, that are pretty visible. The first, when I look at the U.S. and I look at the U.S. foreign policy, it seems pretty clear that the U.S. is essentially retrenching on its own borders. It's taken the lessons from the failed Ukraine war, and it's come to the conclusion that, look, we actually can't project power that far. Our weapons that we thought were terrific are not as strong as we thought they were. When we look at the actions of the Trump administration, it's pretty clear that they're essentially trying to retrench onto the Americas. I mean, that was essentially J.D. Vance's speech to Munich, right? Now, J.D. Vance's speech to Munich was he was coming in to break up with Europe. Now, usually when you break up with someone, you have the decency to say, it's not you, it's me. Sorry, it's not you, it's me. J.D. Vance came out and said, it's you. You suck. And so I'm walking out of this relationship. And at the same time, essentially what the U.S. is saying is not only are we like retrenching onto Fortress America, or maybe we could call it Fort Monroe, at the same time, what we're doing is we're going to kick everybody out of the Americas. So Argentina, you can't do deals with China anymore. Panama, we got to get the ports back. Venezuela, get China out of there. This, I think, will end up being the negotiations with China. It's China, you get out of the Americas, and we'll get out of Asia. And that is a trade that Xi Jinping will be very happy to make. So today in Asia, suddenly everybody's going to be much nicer to China because the writing is on the wall now. So in this world, where does that leave you? That leaves me actually super bullish Latin America. It was very interesting that in these tariffs, Latin America was completely spared. Not only did they get a blanket 10%, but pretty much everything they export, whether copper, whether silver, lithium, etc., was spared tariffs. So, from here on out, the U.S. is going to be very, very nice to Latin America. Meanwhile, Latin America is one of the most undervalued asset class out there. You can buy Brazilian bonds today. You can buy Brazilian tips for 8% real, or 15% nominal on the 10-year Brazilian bonds with 4.5% inflation. Like, why wouldn't we do that all day, every day, and twice on Sunday? Like, you got to absolutely back up the truck, I think, on Latin American assets. That's the obvious one. Looking around the world, other obvious assets to me are assets that have been absolutely decimated because they were perceived to be the big losers in the unipolar U.S. world. China, everything linked to China obviously stands out, but the one that stands out the most to me is Chinese distressed debt. Chinese distressed debt was trading at 50, 60 cents on the dollar. When Russia invaded Ukraine, everybody decided China's uninvestable. Everybody redeemed. There was no market, and this stuff is still trading at 10 cents on the dollar. At a time when, again, China's going to be stimulating. So you can buy today Chinese distressed debt at 10 cents on the dollar, knowing that the banks are going to go into overdrive. To me, that seems like an amazing risk reward. Europe, the valuations aren't that cheap, but again, you're going to have the fiscal tailwinds. So all this to say that in this world that reorders, new opportunities are emerging here and there that, to me seem pretty obvious.
James?
Two follow-ups for our friends. Firstly, Louis, there's been a lot of commentary again this week, the usual analytical mistake, which is always China must. The China must XYZ viewed through the prism of Western capitalism markets is not a great way to think about it. And you know where I'm going with this. The China must deval story is running hot again this week. Can you just talk to that for a second for us all?
Sure, happy to. Look, China's running a trade surplus of 1.1 trillion US dollars. There is no problem of competitiveness of Chinese industry. Meanwhile, I invite all your listeners to, if they don't know where they want to go on a holiday, go to China. It is now so cheap. You can stay at the Four Seasons in Beijing or the Rosewood in Shanghai, etc., for 200, 250 US a night. These are as nice a hotel as you've ever stayed in. So China today is super, super competitive. You can buy really nice electric cars for 9,000 US dollars. So with, by the way, self-drive cars, self-drive now. If you want to self-drive on Tesla, that's $8,000, and you still need to buy the car. So it's China is so competitive today; it is crazy. China does not need a devaluation. China's problem is first and foremost that consumer and business confidence has been crushed. Been crushed by a number of government decisions. It's been crushed by the fears of the trade war. It's been crushed by COVID. It's been crushed by the real estate bust. It's been crushed by many things. If you want to boost consumer confidence and business confidence, you actually raise the currency. You don't devalue it. So, look, James, I think here we're at a super interesting crossroad where if in the next 6 months China does devalue the renminbi, it will have been a big policy mistake. I'll add one last thing on this. It's the fact that the yen is going up very rapidly now gives them probably more comfort, more room to revalue the renminbi. Because if you're China today, your main competitor for your industry is now Japan, especially when the yen was so cheap.
Thank you for that. And Ted, if I may go back to Marko and just respond, let's be clear for our listeners. We're not talking the end of US exceptionalism full stop. I think to drill down a bit, we're talking about a probable end to US outperformance versus other parts of the world. I think that's the essence of it. And I'm always intrigued when any market anywhere and anything is described as exceptional, and it's not to pick a fight with it. But if you compare that with a position that's well researched in anything that's described as uninvestable, you've probably got a very interesting portfolio, particularly if it's tilted to the uninvestable that most people just can't be bothered to investigate. And to take it one step further, yeah, we do need to keep an open mind about what Marko said. The clients I work with blanket selling US assets. They are not. They are not. For the past month and a half, the tactical ones have been increasing their dollar hedge ratios versus various currencies, which is the first step. And a lot of them had pretty low hedge ratios because they didn't need to hedge. You know, being unhedged overweight US equities has been a great winner, not least for Japanese retail investors in their NISA accounts. And that's just one example. It's been a great winner for every private bank. It's been a great winner for the world to be unhedged overweight US equities. And then you have this. So in some cases, you may need to trim risk and certain equity exposures, but you certainly focus on the currency first and foremost. And to be blunt, to see the euro up 2%, or at least at the top earlier today, up 2% 2 days in a row, tells you that there's some very powerful capital flows coming out of dollars into euros. And that's before we consider the Canadian dollar and the yen. And it's quite interesting, Marko, isn't it, that the currencies of massive surplus countries are outperforming, which makes perfect sense. It makes perfect sense. But amidst this turbulence, Ted, I think the key, especially for your core audience, is that there are a lot of things that will get thrown out. And if you've got a fully funded balance sheet, which applies to most of your audience in the most wonderful way, now's the time to sharpen the pencil. And to see some of the world's largest pools of capitals putting in a bid, effectively being net liquidity providers to specific assets. And let's be clear, not at a beta level, not at an index level, that's not right. But on Monday morning, to see some of these elephants start to dance by just being net liquidity providers on very specific assets, whether they be particular bonds or particular currencies in some cases, or most of all, specific equities, which just got smashed inconsiderately, is absolutely the right thing to do. And that's probably the mindset for every long-term, fully funded pool of capital, and generic term for sovereign wealth, endowment, foundation, family offices. Sharpen the pencil. Because Marko's right. I mean, it's difficult transition, to put it mildly, but you can imagine a path through this eventually. Now, it may not mean US asset outperformance continues. It may mean that we prefer other jurisdictions. And I think that's probably true to Louis' point. But it doesn't mean people give up on the United States altogether. It doesn't mean they quit. It just means there's a difficult transition. And if we believe this is a path through it, or let me rephrase, if you believe there is a path through it on a 6 to 9 month basis, then now's the time to sharpen your pencil and be a net liquidity provider on assets you know the best. So not blanket index, not a shotgun, rifle shots. This is what it's all about.
Marko, at the top, you mentioned the constraint of the 10-year. I'm surprised we've gone this far without even mentioning what Scott Bessent is studying all the time. How do you think about the constraints of the U.S. bond market and the reaction function, over the next period of time, more months, years than days?
I mentioned to various members of the U.S. administration 12 months ago that Trump would be a human steepener. And they were not happy with that characterization. One of them actually said, quote unquote, every time you say that on Bloomberg, I gotta go after you and clean up your mess. And I was like, sorry, but this is the beauty of working in independent research. I don't really care. So that's first. The second thing is, it's been proven absolutely correct. When the Fed cut rates, every traditional fixed income investor was like, you got to go long duration. That was the wrong call, and that really alarmed the White House. Actually, I would argue that Scott Bessent is the Treasury Secretary today because of that move. So what we know about this White House is that, yes, they don't really care about equities that much. But let's leave that aside. I do think they are watching bond yields day in, day out. And I think that they had this, scenario in their head that a shallow recession early in the term would be awesome. Private sector in the United States of America has never been less leveraged. Households are basically have as clean of a balance sheet as ever. Households have made $10 trillion in real estate over the last 5 years. And if you could get yields down, not only would they start buying homes again, but they might dip into that home equity through HELOCs, right? So you have this bonanza. All you need to do is bring the 10-year down, and that hasn't happened. They're going to struggle to bring the 10-year substantively below 4%. I think 3.5% is the best they could hope for. And that's just not enough, really, to restart some sort of a re-leveraging of the private sector, because American households are just not, stupid. They don't want to re-leverage at those levels. So I think this is the biggest constraint. Now, there are many other constraints. Louis mentioned, America sells CapEx goods. America sells expensive stuff. You're going to start seeing SOEs and SOE adjacent entities start canceling those orders. Canada's reviewing F-35 order. Politics are a constraint. You've got the House and the Senate talking about taking away tariff rights from President Trump. It's not going to happen, but they're talking. And then finally, I think ultimately, I've got so many polls, Ted, so many polls before, after election. They all say the same thing. Trade and tariffs, least important issue for Americans. The least, by far. We're talking by far. So I don't think Trump is stupid. I think if he had a superpower, it would be that he can sniff out where the median voter is. And I think he must know he's burning a ton of political capital on an issue nobody cares about in America.
James?
There's lots of theories floating around as to why the bond market reversed the way it did. And of course, there has been some deleveraging. But more specifically, it's been people stopping out. It is not the Treasury basis trade unwinding. The Treasury basis trade this week has been fine. At the margins were a few people forced to trim, but the Treasury basis trade does not explain what happened. Nor, as Louis would attest, does the convenient but incorrect rumor that, China must be bashing treasuries and weaponizing. Just ignore that. It is true to say that there was unwind of some massive swap spread positions, which were established on the notion, which is true, that financial regulatory reform is coming. They're going to ease up the denominator of the leverage ratio, which gives people more capacity to intermediate treasuries, which means theoretically swap spreads should be higher, aka wider. So it was logical to put those positions on. But when one person bows them out in size and there's no one on the other side of the trade, and then everything starts to correlate with everything else, off we go everywhere from treasuries to gilts to Japan. And the biggest blow up of all this week was actually New Zealand. How about that? But lovely country, but nobody's really watching. what we've been reminded of this week, and we all know that this is something Scott knows as well, we've been reminded again this week that there is not enough private sector balance sheet capacity to intermediate this enormous stock of treasuries. It's a capacity problem, and it's even more of a capacity problem when you look at the expected borrowing coming from Europe now based on the pivot that Marko and Louis have described. There's going to be a lot of bonds that need to be taken down in a lot of jurisdictions that are deploying fiscal policy to offset this shock. So we have some people would dramatize it as capital wars. I think that's a bit much. But I think we can safely say that there's this growing competition for capital, and the people that look after their creditors will probably be okay. The people that work hand in hand with their financial systems to make sure they're able to intermediate all of this will probably be okay. But unsurprisingly, in a competition for capital and a competition for funding, the big net surplus countries win. And the irony is, when Scott eventually gets to financial deregulation, it's fair to say he's got a bit in his inbox right now, but when he does get to deregulation and freeing up some of the constraints in the leverage ratio, it should serve to dramatically improve the functioning of the treasury market, and that would be a good thing.
Everything we've talked about so far is the liquid markets. And there's a healthy amount of sophisticated portfolios that are in the private markets. And Louis, I know you've been thinking some about the IPO markets and or the lack thereof, particularly in the US. Would love to hear from any of you how you think about longer term, again, 1 to 3 years, the implications of all this for all of the assets held in the private markets.
I can start with that. I mean, I find it very interesting. I sort of introduced geopolitics and politics. I mean, that's my bailiwick, like into finance. It's what I hang my hat on. And for most of my career doing that, private investors have just not been interested in anything that I write about. Or the allocators on the other side. Like the head of alts is usually like, meh, whatever. I don't need this. I'm in it for 7-10 years. I can ride these geopolitical alpha moments. But my view is that geopolitics is not a short-term thing. You should almost always fade it. It's really a long-term impact. And so what's happening right now in the US, and I don't want to be too facetious or critical, but the US is starting to trade in many ways like an emerging market. And so if you are in it for 7 to 10 years in an illiquid way, you do have to start asking yourself, where is this headed? ChatGPT is formulating critical policy. The great master race of penguins of Herd Island is seen as a competitor. I mean, that's a bad look. And obviously, if you want to talk about where U.S. assets are massively overbid, I think privates are even worse than public. There just really hasn't been much of a private equity play in Europe or anywhere else. There was a huge one in China. That was the alternative. If you were if you were an alts director or head of alts at a, sovereign wealth fund or pension fund, that was that's where you kind of let your hair down. And of course, that was cut off 5 years ago. So I think that there's a problem here in the privates. Number one, the overweight US in privates is egregious. And number two, we have an epistemic problem in our community, a human capital problem in our community, where we don't even have actual asset managers. We don't have enough of them in private equity, in private credit, in venture buyouts in non-US markets. Now that's starting, and I think some very smart asset managers are starting to staff up for that. But if you're an allocator sitting in a long-term investment shop, you are literally emailing me, James, and Louis, and saying hey, do you have anyone in Europe who does private equity? How do I do this? And so there's a mismatch. And by the way, this is the case also with emerging markets in general. There are 2 macro hedge funds dedicated to emerging markets today, 2 of them. There's none doing commodities. Most commodity asset managers became crypto and digital asset managers. So what we're really offering to the asset managers is a business development idea. We're really talking to their IR team. It's time to start hiring some PMs who can actually articulate this. And in private markets, it's time to start taking Europe seriously. It's time to start taking Latin America seriously. Let's diversify out of US privates.
I was smiling because one of my dad's favorite saying is that if you can sell a fund, you probably don't want to buy it. And it's been very easy to sell private credit. It's been very easy to sell private equity. Now, I think if we take a step back, if you think of your typical private wealth client in the U.S., 55-year-old, starting to think of his retirement, maybe conservative, let's say 50% long-dated bonds, 50% equities, in the S&P 500, 50% TLT. That guy over the past 3 years is now down 11%. He's down 11% against an inflation that is up 11%. So in real terms, the guy is down 22, effectively. Now, funnily enough, against that backdrop, the private credit manager, the private equity manager tells you, oh, I'm up 15% a year. So over that same 3-year period, against bonds and equity markets that are flat to down, the private equity and the private credit managers are nominally up 50%. This is it either stretches the imagination. If it's true, what it means is in the coming cycle, these guys are bound to be massive sources of capital. They've outperformed so much that the rebalancing that you're going to see in every pension fund, in every endowment, away from these strategies back towards listed equities or back towards, frankly, just bonds, it should be relentless. So yes, I think if you're today running a money management firm, instead of thinking, okay, should we launch the private credit fund? The reality is the endowments, they're already overallocated. The pension funds are already overallocated. So yes, today, if you're a young aspiring money manager, you should be launching an equity fund. You should be launching an EM fund. And even if you're doing it with very little money, that's the trade for the next 10 years. That's where the capital is going to go because it's the part of the markets that's completely underallocated. And it's the part of the market that you also know does structurally well when the US dollar goes down. Private credit, private equity were essentially strong dollar trades. Emerging markets, commodities are weak dollar trades. We're entering into a weak dollar world. Move away from what's been overallocated towards the place that there's been absolutely no allocation.
Hey, Louis, do you know any firms in Hong Kong that offer Chinese distressed fixed income and credit?
I do.
What a relief. And we're describing a world where we may benefit for thinking about where the crowds are not. And we may be a little bit early, but now is a great time to try to identify skilled managers. I wouldn't call it niche because Brazil's not a niche, but thinking differently about the world and how we can win from partnering with the flow of money from surplus capital into different things. That's really what we're saying. Finding capacity can be tricky. To be serious, there's probably a fair bit of capacity when it comes to Chinese fixed income and credit and distressed in general, although perhaps not as much as the world needs. I agree on dedicated EM funds who are probably licking their chops, particularly on the back of dollar weakness. All of that is good. But there's something else that you've reminded me of. Look, I think all of us are a little bit skeptical about how private everything might perform if we have 2 quarters of really poor growth in the United States. Because at a minimum, we're going to have a rising default premium, even if we don't have actual defaults. How does private XYZ perform if cash flows are effectively turned off for 2 quarters? What's it like? And it's different to COVID because inflation is above target. And by the way, we haven't even talked about the Fed yet, which is extraordinary, but such is the world we're in. And come to think of it, if we were having this exact conversation in April 2020, it would have been Fed. And here we are. So inflation's above target, so we can't rely on the Fed, although the Fed will be there in the background. But in parallel with private everything, who have been the biggest beneficiaries of the endless recycling of global surpluses into every type of US asset? Who have been the toll collectors? And the answer is listed asset managers in the United States and the private equity, private everything juggernauts in particular. They have crushed it. Now, people are going to say, uh-oh, this sounds pretty bad. No. These guys, as they demonstrate every time they talk, are not sitting there waiting to be hit by a bus. These guys are collectively the best financial engineers and the best businessmen I've ever met and worked with. They are so savvy. Now, people are cynical. Why is XYZ building out the private side of the private client side of their private everything business? Because they can see the world's changing. They can see that you can't be totally reliant on global institutional capital coming into your strategy. You need to diversify, and subject to regulatory approval. If you've got the track record, the expertise, and the skills to offer vehicles to retail investors within reason, subject to every regulatory remit, you should try to do it. And these guys have been preparing for different regimes and different cycles, and they know their share prices might come down. They know there's going to be underperforming assets. They know. And they run various scenarios. And the reason they have all built massive wealth solutions businesses on the side to look after and invest the capital of the families they've bought businesses from is to give them the balance sheet to help them manage through more difficult times during this transition, however long it is. We'd be more surprised if we didn't start to read more stories about private something being under pressure, okay? More stories about people who didn't read the prospectus and tried to get the money out and they couldn't, and all this kind of stuff. A bit like B-REIT and B-Cred a couple of years back, right? All this hullabaloo. Well, that's what the product's there for. That's what it does. So we're going to hear more about that. We're going to hear about difficulties. The share price of these guys are going to be under pressure. It's going to be uncomfortable for people who misjudge their liquidity, or worse, did not pre-fund their liquidity commitment into a private strategy. Because that always gets drawn down at the bottom, doesn't it, Ted? Things will get thrown out. Things will get sold at silly prices. And conceptually, if we can find something that is heretofore uninvestable or not much coverage, and I like the example of Brazilian tips. Frankly, I wish I'd thought of it. I like the example of the human steepener. You know, what are the consequences of the human steepener? Well, guess what? Long-term real and nominal discount rates are probably going to be high for a while. No kidding. So anything that's over-reliant on low and predictable discount rates is probably going to be shaken down. Great. Should we buy it?
So almost everything we've talked about, there is a view that each of the three of you have about problems in the U.S., and particularly, say, the U.S. equity market, the U.S. economy. That, to me, sounds like a consensus from three people that rarely like to be in the consensus. So I wanted to ask you, even if you don't believe it, if you were shorting your own view, is there a path through for the U.S. where this shared view that there's a problem, end of U.S. exceptionalism, moving assets, that the play is to move assets out of the U.S., ends up being wrong?
Of course there is. Absolutely. And you watch this, and you know what? I think Marko said it earlier. The number one risk to, oh my gosh, this is all going to get really rough and stay rough, is that in the middle of next week, the president says, I just had a good phone call with my great friend Xi Jinping. You want to be short on that? You know, and that's out there somewhere. Now, it's, I'm not sure it's next week, but that sort of stuff, for all the chaos, compels you to change your mind. Now, it doesn't mean everyone piles back in to treasuries or US assets in general, but I'm pretty confident if we saw that, there'd be another hell of a rally. No doubt about it.
How about longer term, though?
Credibility. That's what you need first and foremost, is credibility. And if you are a country with a large current account deficit and trade deficit, the facts are you need foreign money to hold it all together, or at least to balance it out. That's unavoidable. So credibility first and foremost, consistency first and foremost, and then a resolution of all these discussions. And you've got to drop all the talk, however robust and sincere you think it is, about taxing foreign capital. You've got to soften the talk about traffic lights, because the four of us might be in a green light country. But if we own all the same things as the red light and the orange light countries, guess what? They own a lot more of the same thing than we do. So just because we're on the green light, if the orange and red light people need to sell, we're going to get hit by a bus as well. So there's a whole range of things there that we're not actually seeing quite yet. We all appreciate and understand that Scott's trying to hold it together, and I hope he succeeds. But boy, oh boy, it's a hell of a job when you're not quite sure what the boss is going to say yet. You're in some kind of family dispute with the Commerce Secretary. You've got Peter Navarro, who went to jail for the president after Jan 6, who's like, I'm just going to throw hand grenades everywhere. But hopefully we might be working our way through the worst of this chaos. And if we are, that is a good thing.
I can jump in here and just say one thing. I think if he gets a deal with China, which I think he will, he's been saying it for a while, I don't think that's good for U.S. assets relative to the rest of the world. I do agree. Assets will rip. That's why I think we probably reached the bottom at 4,800. I think what would require U.S. assets to outperform the way they did last 5 years, I honestly think that the bar for that is geopolitical crises around the world, a restart of conflict, military conflict. That is at this point, given the valuation of the U.S. relative to the rest of the world, I think that's the only way that you can have safe haven flows going back to the U.S. in some sort of a panicked way. My sort of baseline has been, again, even before President Trump got elected, that's why I started with the unsexy story of fiscal policy. I truly believe that what built American quote-unquote exceptionalism is Ozempic. It's steroids. It's fiscal policy, and that's just not going to continue. But I think that 2001 recession is a good framework for long-term capital allocators. What we're going through. So forget President Trump for a second, forget the penguins, forget the tariffs. I just think that if you had a recession in 2025, anyways, like a ceteris paribus one, you would have had the dollar go flat, not really rally as it usually does as a countercyclical asset. And I think you would follow that with 5 years of underperformance of US assets. That's my kind of mental framework. The only way to really get away from it, from a global asset allocation over the next 5 years, I think would be some sort of a geopolitical calamity. For example, China decides it's time to go, America's mean, domestic political pressures are there, and that leads to a reversal.
Well, Marko, really, really appreciate that very rosy scenario for what could make U.S. continue to outperform. Louis?
Yeah, mine wasn't that far off from Marko's, to be honest. I think U.S. gets a bit of, our starting point is U.S. is more expensive than everywhere else, and right now has the worst momentum. So usually the combination of high valuation and bad momentum is a pretty poor one. You can live with high valuation for a long time as long as you have the best momentum, then you attract the capital. So you're back to the situation of thinking, okay, how can we move to a world where the U.S. reattracts the marginal dollar of capital? So that can, I think, come from one of three things. The first is the U.S. has great technological breakthrough. Now, I think in the past decade, 15 years, you really had two different things in the U.S. at the same time. You had the shale revolution, and suddenly the U.S. had a dramatically lower cost of energy than anybody else, and that was a huge advantage. And of course, you had the smartphone revolution, which was very much centered on the U.S., and which in time also led to AI. And there was the perception that the U.S. had this great advantage in AI. Now, right now, the feeling is, okay, the AI thing was overplayed and China's caught up. We also know that when China enters a room, profits walk out. So there's not going to be any profits in AI forever. And that's the situation that a lot of the American big tech companies are today. So either you can change that part of the equation. There's a new technological breakthrough, i.e. a new shale revolution, a new something that delivers massive productivity gains. And right now, I don't see what it is, but it's a possibility. Or the other is that either China or Europe self-implode economically. Now, Europe has this Damocles sword over its head with the euro, which pops up every 3, 4, 5 years. I don't think it pops up over the next couple of years, but that's one possible scenario where you get another round of euro crisis and then everybody flies back into the US again. Again, I really don't believe that's going to happen. But you said, be the devil's advocate. And the other one would be, a really bad problem in China, probably a political problem, riots, and the regime legitimacy coming under question, etc. Which again is completely not my scenario. But you asked me to be devil's advocate.
All right. I think as we close, it might be fun to do a round of winners and losers over the next year. Who do you think, or what markets are the winners and losers? James, go ahead.
I'll just say simplistically, Canada's a winner. I think Europe generally is a winner. I think Japan is a winner. And that starts from currency. And then around that, there's all sorts of other assets that fall out. I think commodities generically, remarkably, are probably a winner too, but I'm less confident. So I'll just say simplistically to set the scene, Canada, Europe, Japan, and then other things.
And losers?
Losers in terms of underperformance is exactly what we've been discussing. And it's just the US is generally okay when all is said and done, but it's not quite as exciting as some of these other parts of the world because there's a bit of a credibility deficit that might take some time to close.
Marko?
I think that non-aligned countries are the winner. And this is what Louis is saying as well, effectively. The non-aligned movement was not much of a movement during the Cold War. It was kind of a joke. And maybe I'm biased because I am from Yugoslavia and we kind of started that. So there you go. But that's what I think is, those are the winners. I also like Europe a lot. I think that one of the things we didn't have time to talk about today is that Europe is going to be absolutely drowned in a tsunami wave of LNG supply that will crash on its shores over the next 2 years. And so, this whole deindustrialization debate is wrong. I also like hard tech over soft, so that's kind of the Peter Thiel bits over bytes. And in terms of losers, I think that the first 3 months of this year, forget Liberation Day and post, but if you just look at asset performance in January, February, and March, that is the truth. That is the truth. If you're a long-term capital allocator, go back, look at the performance January, February, March. That's the truth. You see who the winners and losers are, and that I think is going to continue for 5 years.
Louis?
Yeah, I 100% agree with that. I think the trends that have started this year are the trends that we're going to be stuck with for the foreseeable future. And look, the big shift in the world is that for the past 10, 15 years, everything was organized to essentially deliver goods to the U.S. consumer. The U.S. consumer was at the center of our universe, and this is no longer the case. I'll start off with the losers. The first one is the U.S. consumer. Whenever you have a currency devaluation, you're essentially taking money away from the consumer and giving it to the producer. And so anybody sort of geared to U.S. consumption, I think, is going to be struggling. I have also, and I've written a number of pieces on this, I have big concerns on U.S. corporate debt. I look at 2020 and 2021 were massive years of issuance for U.S. corporate debt. Back then, in the months that followed COVID, interest rates were essentially at zero. And so it was almost criminal for a CFO to not tap the market. And they did. Everybody tapped the market. But with all the money that was raised, they didn't turn around and build factories or add capacity. Most companies just turned around and bought back their stock. Show me the incentives, I'll tell you the outcome. And, everybody, with their stock options, and you had a roaring equity bull markets driven by record share buybacks. Now, most corporate debt is issued on a 5-year basis. So if you look at the second half of this year and the first half of next year, the rollovers are gargantuan. At a time when, again, the appetite of foreigners for U.S. dollar assets is going to be very, very limited. selling bonds in a weakening currency is very hard. So foreigners will not be lining up for this corporate debt. Um, Spreads are already starting to widen. I think that's one big concern. It will be essentially this corporate debt will have to be sold to U.S. investors. Now we talked about U.S. investors already. Your pension funds and your endowments are all loaded up with private equity and private credit that's not returning capital. They've taken losses on equities and they've taken losses on listed bonds. And now they're going to have to turn around and buy yet more corporate bonds with what money? I think for me, the losers are first and foremost on the U.S. assets. On the winners, I completely agree with Canada. Undervalued currency, you're going to see a big increase in domestic infrastructure spending. You're also going to get political pressure on on the Canadian pension funds that are massive to repatriate capital and to bring back money from the U.S. By the way, you're going to get the same pressure on European pension funds. And, all of a sudden, being invested in the U.S. For me, the big winners I already mentioned: Latin American, whether debt, whether equity, whether currencies. And yes, I also agree with Marko. Look, when two big dogs fight, the best thing you can do is not get in the middle. So being a non-aligned country is great. I also think in a new Cold War era, everybody's going to be stocking up commodities, especially whether you believe in the Cold War or not. I think you have to believe that the U.S. security umbrella isn't what it used to be. And so whether you're Japan, whether you're South Korea, whether you're Thailand, whether you're Saudi Arabia, you just make commodity stocks. You buy the copper, you buy the lithium, you buy the whatever else you might need, and stock it up. So I am bullish commodities. And finally, sorry for the long-winded answer, I'm also very bullish on financials. Going back to Marco's point, you look at the first 3 months of this year, and frankly, you look at most of last year, financials were outperforming in pretty much every major market, outperforming in Japan, outperforming in the US, outperforming in China, outperforming across Europe, outperforming in the UK. And, for me, there's two kinds of bull markets. There's bull markets linked to productivity gains, and that's usually tech, and that's what we've had in the past 15 years. And there's bull markets linked to essentially expanding financial leverage. That's what we had in the first decade of this century. I think that's what we're starting again.
Well, I want to take it out with one last question for each of you, which is, as you're looking at what is changing, what is the one either piece of information that you're studying most closely, or the piece of information you wish you knew?
For me, it's ignoring nearly every headline and going to the primary source of everything that someone's alleged to have said, which requires effort. But there's been plenty of examples over the past week in particular of things that people, have you seen this? Not true. Oh, this is what's causing this. Not true, not true, not true. So as hard as it is for people who I subjectively identify as the key players, I go to the source, I go to the transcripts. In terms of the one thing I wish I knew now, it's frankly the obvious one. Who's going to call who first? Is Xi Jinping going to call Trump, or is Trump going to call Xi Jinping? I've really got that on the top of my mind.
In my case, one of the things that I think is very important as investors start to incorporate politics and geopolitics more and more into their toolbox is just to understand that while you as a human being really cares about absolute levels of risk, the market is not human. It's inhumane. It's a discounting mechanism. And I go back to that COVID, like we were all struggling. Like I became an IT guy, connecting my 3 kids with their teachers, It was terrible, but the market couldn't care less about hospitalizations, deaths, this, that, or the other. So when the second derivative of geopolitical risk collapses, when it becomes negative, even if the absolute level is still very high, it's game over. You need to move on. We start to desensitize. And this is very difficult for 90% of investors to do. Once the news becomes less negative, that's all the market needs, even though you yourself are still very concerned about people dying in Ukraine, people dying in hospitals from COVID, and so on and so on. What I want to know, quite frankly, Ted, I'd love to know what Trump is trading. I just want to know his PA. Can I have, if I had an insight into that, I think I would add a lot of value to my clients.
Louis?
Look, I think for me, the main question is, whether what we're going through is a reallocation away from the US to other markets, which is, sort of been my scenario for a while, or whether we're in the middle of a massive, sort of global margin call where everything collapses at once, which is what it felt like, sort of earlier this week. And so this is the bifurcation. Now, usually the global margin call happens when there's a lot of hidden leverage somewhere that you just didn't foresee. What I don't know, and I wonder, okay, if there is hidden leverage today, where is it? And my fear is that over the past 10 years, private banks all around the world, private banks in Europe, in Asia, in America, have made a lot of money selling structured products to private clients that essentially, the clients, were essentially selling vol. They sold products where it's like, okay, I tell you what, you buy NVIDIA, but if NVIDIA goes down 50%, then you lose all your money. But if NVIDIA keeps going up, you make the NVIDIA returns plus 5% or something. And the banks have, made a lot of money because the fees on all these products were very handsome. And so my fear is that, you have a lot of private clients around the world today that think they are very wealthy because of the past 15 years bull market. They think they are very wealthy. And in a market's adversarial event, it's not that they'll go down 30%, it's that they'll go down 100%. And of course, that then impacts, it'll be like a Madoff event. All these people thinking, going to holidays in Saint Moritz or in Aspen and going to Saint-Tropez, spending money because they've got all this money at Madoff. And from one day to the next, you realize the money's not there. So you get this huge air pocket. Now, Madoff was $10 billion. This is on 100, if not trillions of dollars worth of structured products that have been sold at a time when we are entering into these margin calls. So that's my big fear is, it's extremely hard to quantify, but this sort of overhang of structured product is what leaves me terrified and struggling to sleep sometimes at night when I go to bed thinking about it.
Louis, Marko, James, thanks so much in these crazy markets for taking the time to share your thoughts.
This is a real treat to be with these guys and be with you, Ted. Thank you.
Oh, it's a treat for me as well. Thank you so much for all of you. This was awesome.